Welcome back. Time for your business news, and let's kick things off with the top business story. Bank of Japan has raised interest rates to its highest level in 30 years and signaled more hikes ahead as it moves to tame inflation risks fueled by surging energy costs and a weak currency. The central bank flagged price concerns with underlying core inflation above its target of 2%. The BOJ said it will maintain support for the economy despite what it called the reduced risk of a significant slowdown. Quick check on the markets. The benchmark Nikkei 225 hitting a record 70,000 for the first time after the decision. Well, it's currently just under that, but still ahead by more than 0.6%. Checking in on the yen as well. It is still hovering around the $160 to the US dollar rather. Weakness in the currency has persisted despite a government intervention. Growing strains in Japan's bond market also among key concerns. Long-dated Japanese government bond yields have climbed to multi-decade highs in recent months. The BOJ also announced it will pause its reduction of JGB purchases, which analysts say could help to ease volatility in the bond market. To delve deeper into the BOJ decision, we are joined live by Martin Schulz, Chief Policy Economist at Fujitsu from Tokyo. Martin, thanks for joining us. First off, the BOJ has raised rates, no surprises there, but headline inflation in the month of April is still only 1.4%. Now, walk us through why the BOJ has raised rates when inflation does appear subdued.
Well, it's clearly not that the economy was running hot and inflation was popping up as in many other countries. But the reason for that is that the government, from the Ministry of Finance side, was keeping a lid on price increases with heavy gasoline subsidies and also meddling a bit in the food market. This is not the way the government wants to go forward, and the Bank of Japan has signaled it will be in the market of taking care of inflation expectations going forward. Plus, it wants to normalize interest rates to a level where, the yen can stabilize, where long-term interest rates regain some confidence in government policy overall. So it is a clear signal that the Bank of Japan has prepared. Well, we are stepping up with higher interest rates, no matter what is happening in Iran, outside of the economy, because we want to normalize interest rates from here.
So if you strip away the energy subsidies, underlying inflation, correct me if I'm wrong, it's closer to 2.8%. How long do you think Tokyo can keep funding these subsidies, and what happens to that hidden inflation pressure if the yen keeps weakening?
That is really a challenge from the two sides. The government has decided, we need lower interest rates to keep the low interest rates to keep the domestic economy going. But at the same time, imported inflation, cost-plus inflation, was coming in from the global economy on the back of the weak yen, but then also the energy crisis. So it was heavily going into the market with subsidies. But there are so many other things that the government would want to and should do with its funding instead of burning the money with energy subsidies. So it is very clear that there needed to be a signal here. The government also needs relief when going out of the summer, and prices will probably remain elevated. The energy crisis only gradually subsides. So the Bank of Japan is now here raising interest rates, probably not for the last time this year.
And Japan's 10-year yield has climbed to nearly 2.8%. That's a level not seen in 30 years. Does a move to 1%, do you think, help restore confidence in the bond market, or could it add further pressure on longer-term yields?
Well, yeah, you're really hitting the Bank of Japan here from all the angles where it has seen pressure. It is the way too low Japanese yen that was not even supported enough by government intervention. So interest rates were required from that angle. Inflation expectations have been going up again, and then investor confidence with very high bond yields going up to a level of almost 2.8% for the 10 10-year bond. This hasn't been seen in a very long time. It shows that this is not only inflation expectations. This is not only, well, some doubt about growth opportunities. It is also that confidence in government policy has been deteriorating. And this is where the Bank of Japan now says, yes, we have to close that gap and follow up and show that the economy can grow even though interest rates will be higher.
And in your latest report, you've suggested that Japan's more natural policy rate should be closer to 1.5%. Now, after today's move, all eyes and ears will be on the BOJ press briefing later today. What are you expecting to hear?
Well, that would be a very big discussion about natural rates. But if we take it simple, the inflation rate is expected to be around 2%. That would be the target of the Bank of Japan, and it will manage to do that. And the growth, the growth potential of an aging society like Japan is around 0.5%. We arrive at this 1.5%. Now, when we look at rates at 1% right now, one or two more steps in that direction, depending on the state of the overall economy, is what we should really expect for the Bank of Japan to do. It so far was stepping up every 6 months. If it has the potential, could do so, maybe it would do so a little bit earlier, but otherwise, and in December at the latest, it would do another step into that direction.
And what do you think is the biggest risk for Japan right now? Is it that the BOJ tightens further, then damages growth? Or does it stop too soon and then allow for yen weakness and cost push pressures?
The real driver is really the very weak yen. That is a major concern for industry. We are very concerned with cost push inflation in the meantime. Businesses have become much better to pass on these costs, but that produces a problem for the Bank of Japan, of course, with cost push inflation getting into the economy. A slowdown of the economy, of course, is a risk. It was growing in the first quarter significantly. Now expectations are more at 0.5%. But overall, the bigger risk here is that the long-term value of the yen will be undermined. And this would be a major challenge for the economy. The Bank of Japan cannot allow that. The government cannot allow that. So policies are moving into the direction to push more for, well, productivity enhancements, not to burn so much subsidies on gasoline, but to get the economy going, investing more into technology, moving the economy from the productivity side much further. I think this is what the Bank of Japan also wants to support right now.
It sounds like the BOJ has many balls to juggle. Martin, thank you for those insights and analysis. That was Martin Schulz, Chief Policy Economist at Fujitsu.